We are often conditioned to believe that the path to early retirement and financial security is strictly linear. Higher income equals faster freedom. But today, we challenge that fundamental assumption with a striking paradox. Imagine two individuals. One earns $150,000 a year, drives a new luxury car, and lives in a desirable high-tax neighborhood. The other earns a modest $40,000, lives modestly, and drives a reliable older vehicle. Intuitively, we assume the high earner is winning the race, yet behavioral economics proves the exact opposite is often true. The 40K earner, through discipline and strategic mindset, often reaches true wealth decades earlier. This disparity hinges entirely on one concept: the difference between being merely rich and being genuinely wealthy.
Let's define rich. Being rich is a metric of cash flow. It means you have a high income and the ability to consume expensive goods and services today. Richness is visible. It's the external display of status, the branded clothes, the annual exotic vacations, the massive house. However, this high consumption often requires continuous high income simply to maintain the lifestyle. If the income flow stops, the entire structure collapses because the high fixed expenses and often substantial debt load require constant fueling. The moment the $150,000 job disappears, the rich individual finds themselves deeply financially vulnerable, tied down by golden handcuffs of their own making, despite the impressive salary they commanded.
Now consider wealthy. Wealth is not measured by income, but by net worth and freedom. Wealthy individuals prioritize asset accumulation, investments, properties, businesses that generate income independent of their own labor. Wealth is invisible. It is the quiet confidence derived from low overhead and high resilience. A truly wealthy person can stop working today and maintain their lifestyle for a long period, perhaps indefinitely. They view money not as a tool for immediate consumption, but as a seed to plant and grow. This mindset shifts their focus from maximizing gross pay to maximizing their savings rate and minimizing their fixed liabilities, the cornerstone of true financial freedom, regardless of their starting salary.
Let's dive into case study 1, the 150K trap. The high earner quickly falls victim to lifestyle inflation or lifestyle creep. They believe that because they earn more, they deserve to spend more. They commit to a 30-year mortgage that consumes 30% of their gross pay, finance a car that demands 8% of their monthly income, and constantly upgrade technology and leisure experiences. This rapid escalation of fixed costs means that after mandatory deductions, taxes, and high living expenses, their actual discretionary income available for saving or investment might be shockingly low, perhaps only 5 to 10%. They are playing catch-up, constantly needing a bigger paycheck to service the rising cost of their perceived status, effectively maximizing their required work duration.
The math behind the $150,000 trap is brutal. In many high-tax jurisdictions, a large chunk of that income, potentially 30 to 40%, is immediately consumed by federal, state, and local taxes. Then comes the cost of keeping up appearances, the premium childcare, the expensive zip code tax, and the need to entertain clients or colleagues. If this person manages to save only 10% of their gross income, that's $15,000 annually. Assuming an average return, they would need over 4 decades to accumulate enough capital to safely cover their existing $135,000 annual expenditure, not accounting for inflation. Their high income has enslaved them to a high consumption rate, making their path to retirement lengthy and highly dependent on continued professional success.
Contrast this with case study 2, the 40K strategist. This individual has chosen a fundamentally different metric for success: maximizing the savings rate. They might prioritize geographic arbitrage, choosing a low cost of living area, or embracing voluntary simplicity. They drive the older car, rent a modest dwelling, and are expert budgeters. This isn't about deprivation, it's about intentional spending aligned with values. By aggressively minimizing fixed costs, the 40K earner might only require $20,000 annually to cover all expenses. This leaves $20,000, a staggering 50% savings rate, available for investments. Their behavior, not their gross income, is the engine of their wealth creation, fundamentally changing their financial trajectory.
The 40K strategist's math is dramatically more powerful. Saving $20,000 per year might seem slow, but when paired with the principles of the FIRE movement, the timeline shrinks drastically. The key principle is the 4% rule, which states you need 25 times your annual expenses saved to achieve financial independence. For the 40K earner, their expense base is only $20,000, meaning they need a net worth of only $500,000 to retire. At a 50% savings rate, assuming 7% market growth, they could potentially hit that $500,000 mark in just 10 to 12 years. Meanwhile, the 150K earner, needing $3.4 million to cover their $135,000 expense base, is still centuries away on their meager 10% savings schedule. The required work duration is inverted by behavior.
This brings us to the core metric, the savings rate. Forget income level for a moment. Financial independence is driven almost exclusively by the percentage of your income you save and invest, not the absolute size of your paycheck. If the 150K earner started saving 70% of their income, they would retire almost instantly. If the 40K earner only saved 2%, they would never retire. The savings rate dictates how quickly your invested capital surpasses your living expenses. It's a simple, undeniable equation. Higher savings rate equals lower reliance on future earned income. This powerful behavioral tool is accessible to everyone, regardless of their current salary bracket, and it is the true differentiator between those who perpetually chase money and those who make money work for them.
The true challenge here is behavioral economics, the mastery of self. The 150K earner often struggles with impulse control and suffers from a psychological phenomenon known as hedonic adaptation, where every new purchase quickly becomes the new normal, requiring an even larger purchase to deliver the same level of temporary satisfaction. The 40K strategist, conversely, has mastered delayed gratification. They derive satisfaction not from consumption, but from watching their assets grow and their freedom increase. They understand that every non-essential dollar spent today is years of potential retirement sacrificed tomorrow. This internal psychological victory over consumerism is the greatest asset they possess, far exceeding the value of any salary increase the high earner might receive.
Another critical component is the power of zero debt. The 40K earner is usually prioritizing the elimination of non-productive debt, particularly high-interest consumer debt. Every dollar they don't spend on interest is a dollar that can be immediately invested. The 150K earner often carries substantial mortgage debt, car loans, and sometimes credit card balances associated with maintaining their appearance. Servicing high debt acts as a negative multiplier on income, effectively forcing them to earn tens of thousands extra just to break even on interest payments. The lack of debt for the low-income earner provides incredible flexibility, making their modest cash flow vastly more robust and potent than the high earner's complex financial structure.
Finally, we must consider the incredible force of compounding interest applied over time. Because the 40K strategist began investing their significant savings rate earlier, even if with smaller absolute dollar amounts, their money has more time to compound, leading to exponential growth that the high earner who started saving later can never catch up to. The 150K earner might only start serious saving in their 40s, once lifestyle inflation finally slows, but they have already lost 2 decades of the most powerful compounding years. Time in the market is often more valuable than timing the market or the size of the initial contribution. The behavioral choice to save early and consistently ensures the low earner utilizes compounding to its maximum potential, securing victory in the wealth race.
The ultimate takeaway is clear. Wealth is a result of calculated behavior and disciplined mindset, not simply a function of your tax bracket. The rich person is selling their time for money to finance a lifestyle. The wealthy person is buying back their time by minimizing expenses and maximizing asset growth. If you are earning $40,000, $80,000, or $150,000, the principles remain the same. Determine your ideal cost of living, ruthlessly optimize your savings rate, and prioritize asset accumulation over consumption. This fundamental shift from maximizing income to maximizing savings rate is the most powerful financial choice you can make. Take control of your behavior, and financial freedom will follow. Don't forget to like and subscribe for more updates and strategies on mastering your